Have you ever dreamed of owning a casino? Well, you can, through a REIT. Real estate is a powerful way to build wealth, but what if you don't have the capital to buy properties yourself? That's where REITs come in, letting you invest in real estate without the hassle of actually owning or managing properties. What is a REIT? A REIT, or Real Estate Investment Trust, is a company that owns and manages real estate assets like commercial buildings, apartments, and even mortgages. Instead of buying a property, you buy shares in the REIT, just like you would with a stock. More videos will be made on this topic in the future. Make sure to subscribe so you do not miss them. There are two main types of REITs. 1. Equity REITs. These own and manage physical real estate. They make money by collecting rent from tenants. Think of owning a piece of the Empire State Building, collecting rent from businesses like LinkedIn or Booking Holdings. 2. Mortgage REITs. These don't own properties. Instead, they invest in mortgages and mortgage-backed securities, making money from interest. It's like being the bank. Most long-term investors stick with equity REITs because they're simpler and more predictable. Mortgage REITs, however, are more complex and can be riskier for new investors. How do REITs make money? REITs earn money in three main ways. 1. Rent collection. The primary income comes from leasing properties and collecting rent, which gets paid out to investors as dividends. 2. Property appreciation. As real estate values rise, REITs can sell properties for a profit or see their assets appreciate in value. 3. Property development. Some REITs also build properties from the ground up, creating additional revenue once those properties are leased. Take VICI Properties, for example, one of the biggest names in the REIT world. VICI owns some of the most famous casino and entertainment properties in the US, including Caesar's Palace. Their portfolio is worth $45 billion, with a market cap of $32 billion. Investors in VICI get a 4.5% dividend yield. That's $4.50 for every $100 you invest, paid out annually. With long-term leases and built-in rent increases, VICI offers steady cash flow and growth potential. VICI's steady cash flow comes from long-term leases, typically 15 to 20 years, with built-in rent increases. This creates predictable revenue, keeping the business solid even during market fluctuations. Nearly 100% of their properties are leased, which means consistent rent payments and fewer risks. On the financial side, VICI's debt-to-capital ratio is about 45%, meaning they use debt wisely without over-leveraging. In 2024, they reported $2.72 billion in funds from operations, FFO, ensuring plenty of cash flow for dividends and expansion. Since spinning off in 2017, VICI has expanded from just a few properties to 93 assets, including 54 gaming properties and 39 experiential venues. They've diversified well beyond Las Vegas, increasing their growth potential and stability. Why invest in REITs? REITs are a great way to get into real estate without owning physical property. Here's why. High dividends. REITs often pay higher dividends than regular stocks, providing a solid return on investment. Tax considerations. REITs must distribute a large portion of their profits as dividends. However, these dividends may be taxable, so it's important to understand the tax implications. Diversification. REITs give you exposure to various real estate sectors, from office buildings to shopping centers, all in a single investment. Professional management. Unlike direct property ownership, REITs are managed by experts who handle acquisitions, leasing, and maintenance. Liquidity. While physical real estate can take months to sell, REITs trade like stocks, making them easy to buy and sell instantly. Growth and capital structure. Since REITs distribute most of their profits, they rely on debt or issuing new shares to fund expansion. Investors should monitor leverage levels, how much debt a REIT uses, and be aware of potential ownership dilution. However, when REITs issue new shares, existing investors are often given the opportunity to participate. Low-cost entry and learning opportunity. REITs provide an affordable way to gain real estate exposure and learn about the market without needing significant capital. Predictability and market behavior. Thanks to consistent rental income, REITs tend to be more stable than regular stocks, acting as a buffer during market downturns. However, they are still influenced by broader market conditions and interest rates. Investing in REITs, direct or via ETF. When it comes to investing in real estate through REITs, you have two main options: buying individual REITs or investing through a REIT ETF. Each has its own pros and cons, depending on your investment style and risk tolerance. Types of REITs cover a wide range of property types, each with its own characteristics, risks, and rewards. Here are some key categories. Retail REITs own shopping malls, outlet centers, and strip malls. They perform well when consumer spending is strong, but e-commerce competition can hurt them. A great example is Simon Property Group, SPG, which owns some of the largest malls in the US. Residential REITs focus on rental properties like apartments and condos. They benefit from high housing demand, but if home ownership becomes more affordable, rental demand may decline. Avalon Bay Communities, AVB, specializes in luxury apartment living. Office REITs lease office spaces to companies. Long-term leases provide stable income, but the rise of remote work has reduced demand. Boston Properties, BXP, owns premium office buildings in major cities, but faces challenges from changing workplace trends. Industrial REITs are booming due to e-commerce, as they own warehouses and distribution centers that keep supply chains moving. Prologis, PLD, serves giants like Amazon, but economic slowdowns can reduce demand for storage space. Healthcare REITs invest in hospitals, medical offices, and senior living facilities. An aging population drives demand, but changing healthcare regulations can impact profitability. Welltower, WELL, is a major player in senior housing and medical properties. Data center and infrastructure REITs own critical digital and physical infrastructure, such as data centers, cell towers, and fiber networks. These are essential for modern communication and cloud computing, but high operating costs and tech advancements can pose risks. Specialty REITs cover niche sectors like casinos, prisons, timberland, and farmland. While these REITs offer unique opportunities, their success depends on the industries they serve. REITs investment would fit within the high-yield section of your portfolio, alongside your broad market and high-growth sections. With so many options, REITs allow investors to tap into real estate's income potential, whether through residential, industrial, or even digital infrastructure. Whether you're interested in traditional commercial real estate or something more unique, like casinos, REITs offer an accessible way to earn steady income and diversify your portfolio. But as with any investment, it's crucial to understand the risks and tax implications before diving in. What property sector interests you the most? What other asset classes are you curious about? Let me know in the comments. Be industrious, brothers. Are you ready to join us on this journey? Are you ready to win? If you're enjoying this content, show some love, hit the like button, and give it a thumbs up.